All right, I'm so excited for today's episode. Thank you, Scott Fisher, for joining us. We are going to be talking about the one question that I think most business owners, whether they're franchise owners, independents, everyone really wants to know what their business is really worth. And I think this is a really important time to talk about it because, as we know from COVID, there were a lot of crazy things that were going on in the last few years. So it's a really good opportunity to kind of reset and look at the true value of your business. So that's what we're going to do today. The first thing to think about, and I think Scott can speak to a little bit, is when we think about the value of our business, right? A lot of times it's when we're thinking of selling or thinking of exiting, right? When have you gotten that question?
I think you're right. I think people wait till they're doing these things instead of trying to build their business to what they want the value to be.
Right.
Right.
Yes. So if we think about this like real estate, right? We don't want to think about the value of our house when we're putting it on the market. We really want to be thinking about that all along because your business, like your house, your car, it's an asset. It has value and it always has value. But really what we want to do is make sure the decisions we make are driving us to a greater value a year from now than what we have today. So when we look at this, we have several different methods of valuation that we're going to talk about. But the other key element here is that this is a changing number. So if you think about, again, like real estate, there's market trends, there's things going up, inflation, and the same is true on the business side, that you really can create your own destiny here. So if you purchased a business a couple of years ago, if you've grown to more locations, if you've taken on more, all of those things change the value of your business. So we want you for a moment to stop thinking like the day-to-day operator, and we really want to think of it as you're an investor, which you are, right? You are investing your time into something that will have value in the future. And that's what this is really all about, is getting you to understand that you're exchanging your time today for something that you really could sell for, a multiple of whatever in the future if we really think about these concepts every day. All right, so when we look at this, there's the first method that we're going to think about is, the first thing we're going to think about is what we need to do to come up with this number. Now, what we've given you here is a list of the documents that we're going to have, as well as some of the initial questions that you want to answer. So the first one is prior 3 years reports. Ultimately 3 years tax return is really what most go off of. Now I know you might be saying, well, that includes COVID, right? So even if it's okay, right, we're going to have to show 2020,
Sure.
right? And that's okay. Other thing is income statement, balance sheet. And then the last part, which I think we've seen a lot, is owner, right? Like what are some of the non-recurring things? Maybe I decided to pay myself during COVID. And, what are some of those other things that were kind of outliers that we want to think about as telling the story? So, Scott, when you're talking to business owners, how do you hear them talk about, I guess, explaining the last 3 years? Has this come up for you?
Yeah, I think they've transitioned from COVID to post-COVID, and operations are somewhat stabilizing. But now they're getting back into, and I feel like a lot of times, using your expertise on, well, how do we pay ourselves? Is it a salary? Is it a draw? Should I put my car on our thing? So all these other factors that go in from a tax side, but now as we talk about valuation side, also because their expenses coming out of the business.
Yes. And I think that's also the case is that, for us, I know a lot of times we're on these calls together, but we really just want transparency, right? Like the first starting point is to be honest about what's happened in the last 3 years, how you've compensated yourself, how you've compensated your family, what are some of those other things, and really showing up with all these documents put together without changing anything, because we need to evaluate where you are first before we can come up with a plan to get your valuation even higher. So, okay, so then when we look back at the last 2 years, because again, if we were going to do this exercise today, we're going to be looking at 22, 21, and 20. Probably not the best years for your restaurant, but that's okay, right? We've had clients the last few months that have been able to sell their business, right? So it's not like you can't sell your business, but we want full transparency, especially with some of those government programs. So whether you took advantage of ERTC, PPP, if you potentially closed, all of that we just want to make people aware of, because how you performed in 2020 doesn't necessarily mean that's how your business is today. Right? And have you seen, like, from a sales standpoint, right? If I said, let's say I closed half the year of 2020, that's still okay for where I am today, right? I've been able to rebound.
Right. Exactly. You're showing now how you did versus last year.
Yeah.
So all those numbers that you're doing now are your real numbers. We're seeing a lot of them that are bouncing back stronger. I think a lot of our operators that did really well are now seeing other avenues of sales going, like takeout. They're actually making their business busier than before that. As we're a few years out now, I think as long as your numbers now are strong, they'll understand where those numbers come. You're explaining the story of how they got there.
Exactly. And I think the other element, like you bring up, is you probably did a price increase in the last year. So that actually helps you a little bit, because chances are, even if your customers were down a little bit, chances are your top line has gone up just from the 10 to 15 to 20% price increase that you had to do in the last 3 years to keep up with inflation. So, okay. So the next piece, which again comes up a lot, is we get this question of, well, what about owner earnings? And I think, again, going back to that investor standpoint, that's really such an important question, because if you want to sell your business, you have to prove that there is value here and that there are real cash dollars that the next owner will be able to benefit from. So again, so many times this is a hard thing to wrap our head around, because historically, if you're kind of in the old school, right, we didn't want to show it, right? We didn't want people to see. We just wanted the shoebox in the corner or under the mattress or whatever it was. Well, that's fine until you try to go sell your business, because the person buying is going to want to do what they call due diligence. They're going to want to go through bank statements, and they're allowed to do it. They're going to want to go through POS reports. They're maybe going to want to come into your restaurant and walk around and see. And if they don't see earnings to you, then they're not going to want to invest. So this becomes a really important thing, because what we want to do is look even beyond, like you said, paying yourself. Although I would definitely say, if you want to sell your business in the next 2 to 3 years, you have to show a salary, right? You don't technically have to. It's not against the rule if you don't, but I'm telling you, buyers today want to see a salary. They don't want to see a draw. There's a lot of uncertainty, especially in hospitality. They want to see that you're cashing a check every 2 weeks, and that it's one that they can live off of as well. But then we also want to look beyond that to say, car, if you have your car in your business, cell phone, home office, all of those other things that even if you say, go once a year to a show and there's some travel in there, all those are justifiable business expenses. But what we want to look at for owner's benefit is, what are some of the discretionary things that you did that maybe the next person doesn't have to do, and those we would want to take out as, owner benefit things that actually are an add back to your bottom line.
Yeah, especially if you're the owner, but you're the general manager of your restaurant, that next owner can decide if that salary will pay himself or herself for the OBGM, or if they'll hire a GM. But like I said, as long as numbers are in there, they can then decide how they want to move forward with them.
Right, and that is such a great point, because I think so many times we think we're helping our business, right? I'm going to go work on a Saturday night, and I'm not going to pay myself.
Right.
So I just hurt my business in 2 ways, right? Because I gave away free labor. Right. If I wasn't there, someone would have to get paid for that time. And I didn't pay myself anyway, right? So we really have to pay ourselves.
Yes, and I mean, depending on how many roles you have, really should probably depend on what you're taking as your salary, and then you can get into all the bonuses and withdrawals later, but at least that this salary is worthy for the position you're running in your restaurant.
Yeah, and that's where, I think this goes back to being an investor, right? If you're investing your time, we're not trying to be greedy here. We're not trying to, have you flying off in a jet somewhere, but you have to value that time, right? And if your business can't sustain you, no one else is going to come buy your business. But that doesn't mean that all hope is lost, right? I think we've had some great conversations in the last, few months of really breaking this out like a math equation, right? What is the prime cost, the food cost, the controllable labor, all those numbers, what do they have to be to get you those dollars and make sure that your business is sustainable? And that's what we're talking about here. If you feel like, well, I've never paid myself, I haven't gotten a dime, that's okay. Right? Today is a brand new day. We don't have to sell based on the numbers that you have today. We just need to set a path forward so we can develop a plan so that your business is valuable when you want to sell. And I've had places, I had a gentleman I worked with 2 years ago who bought a business. You could tell the owners had taken 3 years to get all their numbers right. Like they had the salary, they had everything documented. And you know what? They got a great dollar for their business, right? And it was true, right? It wasn't like he bought a bad business. It was a great business. But you just knew they had done everything with a purpose on those last 3 years. So it was completely clean and there were no questions when he went to do his due diligence. And that's what we're talking about here is that even if your goal is to sell, waiting a year and getting everything cleaned up first, waiting a couple of years will have a higher value than just trying to sell now based on the last 3 years.
Right.
All right. So the next thing we're going to talk about is a little bit of the math behind what if I, want to sell or I just want to have a starting point of what my business is worth. How would I come up with that number? Okay. So the first thing that we're going to do is kind of walk through the valuation formula. So what that is, again, we said we're going to gather our 3 years. Now, a lot of times, especially what we've seen, like you mentioned, is 23 may be your best numbers, right? 22 may have still been bad, 21 was even worse, 20 was non-existent. 23, we're now halfway through the year. We could potentially do this based on current year, right? And that's okay. And a lot of times people have, if you're working with us, a CPA, or, someone can write a letter to say, this is half year information, but there is a way to still get it signed off on and something that could be used for the valuation. So either way, we're going to use, for this example, we said your bottom line from 2022. A lot of times they like that because that's your tax return. Now again, we've had conversations. It's okay to want our bottom line to be strong, but then when we look at our tax return, we can't take it all off for the tax return, right? Like we want to show a profit because that is the value of our business. So we have to, and that's okay because that's part of being a profitable business. So again, getting rid of that old school approach because that does not serve you in valuation. So we're going to take our net income, and then the next part is that owner compensation. Again, like we talked about, we really want that W-2 wage, right? Yeah. And ideally for what you're doing in the organization. So if I'm a GM, I would probably want to look at market rate for what I'm paid.
Exactly.
And maybe look at, what even you can Indeed it and to look at what's the salary for a district manager and some of those other things.
Depending on how many restaurants you have. And again, because the owner coming in, you don't know exactly what role they want to play in the organization. Yeah. So, like Ann said, if it's clean and you have 5 restaurants and you're a pseudo district manager, but you're paying yourself whatever a district manager should make, that allows it in the sale to be decided if that person wants to come in. Make sure, more, someone wants to come in and take over your business with that is already built into it.
Yeah, and I think it's okay. I mean, you do a great job on the labor side of really kind of tying it back to hours, right? So, if you're putting in the hours, that's okay, but we want to make sure that those hours are captured as part of the hours your organization needs every week or every month.
Right. And like you said, if you're working 90 hours in your business, well, how is that being accounted for? I mean, that's the part of it that, if you're working a normal manager schedule, okay, but if you're not, how are you accounting that in your valuation and into your
and especially if you're not paying yourself, right? And that's the one thing that I would say, I believe the never again of 2020 is you have to pay yourself for your time. You just have to. And there is a way to figure it out. I don't believe that figuring out is closing, right? Or it can never work out. It's really going back to the table to say, okay, if I have to make this, then how do I make everything else work? Because I promise if you have to take a payroll, you're going to find a way.
Right.
You will. You're going to be creative in the labor and expectation of your labor team.
Yep.
Yeah. So, all right. And then the other part is like we talked about, other benefits. Those are going to be added back. Oh, go back. Okay. Wait, go back. One more. Yeah. Okay, we're still on that. Okay. So now, what we're going to do is the next part is that gets us to our operating income. So just using rough numbers, if we had a net income of $100,000, owner makes 50, now our income for purpose of valuation is 150, right? So we're literally adding that back because as the person buying the business, they would get the 150, not the 100.
Right.
So now we're going to take that 150, and then the general multiplier for hospitality is 2.5. Now, I've seen it higher if you have, very high volume, if you're in a good location, all these other reasons, but baseline as a place to start, it would be taking that 150 and multiplying it by 2.5 to get to our valuation. Now, you might say, there's no way that's what it's worth. And this is where I say this is such a good exercise to do before you actually want to sell. Because even if you're someone who bought a business, right, let's say you bought, 3 franchise locations, 5 franchise locations, you would want to do this exercise too to see, is it living up to the money that you have put in, right? And you've seen that even in some of the larger franchises, right? Like you invest a ton of money.
Sure.
And you want to know if you get it back.
It's a great question. I mean, I think that's where, you said you invested a ton of money. You're probably investing time and energy and all these things. And if that investment doesn't get you what the money market's paying you, right? Like, it's probably not a great investment. I think that's where, it's not always as fun to run a restaurant if you're not capable of doing it. And I think when Ann says, if you break it down like this, you're really going to know what is it actually as an investment, if that's what you're doing it for.
Well, and then, from this starting point, we can then say, well, how do I get it there, right? Again, this is not saying, oh my God, I'm going to now bury my head in the sand and walk away because I can't get to the number I need it to be. This is really all a starting point to say, we know we can get it there, but we need to know the gap first. So if we get to, 600,000 and we invested $1 million, well, now we really know what we need it to generate to get to that number. Because I don't believe, especially with all the uncertainty, I don't believe the multiplier is really going to change, right? This is the most common way to do evaluation in hospitality, and I'm telling you, we have a software and it pretty much does this exact same calculation. Well, it does a really pretty report, and that's great, but this is pretty much it, unless you're, kind of an outlier with revenue being higher, or there's, some other things we'll talk about, but really this is the baseline as a place to start. Okay, so the next piece that we could potentially add in, and again, I really take this with a grain of salt because we've worked with a ton of people who have gone through the buying process, both as a buyer and a seller. We've worked with brokers. We've seen this a lot, and what we just covered, 95% of the time. But it is worth noting, and again, if you're someone who's thinking of selling, there are things you would want to highlight for a potential buyer as ways to add to that number. The first one is brand reputation, right? And I think this is important for independents as much as franchises, right?
Yeah, definitely. I mean, if your independent restaurant is known locally and has a great following, that could be very valuable in looking at a reputation, as the valuation, as someone coming in. Maybe they do want to expand on that, and to them, that's the asset plus side is, I'm going to take what this person you've already created and just maybe make it larger to scale.
Yes, and what's funny is I think this is where if you go on like Biz Buy Sell or the brokers, I think a lot of times this is what they get wrong, is that, I've had very successful people who've been, kind of that second generation. They have no affiliation with the first generation, right? They came in, they took a concept that worked, independence, right? The name is Mary's Soda Shop. It's not Mary behind the counter, but that's okay because customers love it. They still come in. Nothing changed. They kept even the name and were able to continue on. So there's no reason that you couldn't showcase the value of your brand, even if it's not still going to be you standing behind the counter.
Right.
The other thing is, I'm talking about customer relationships, being known in the community, right? Charitable things that you might do. I mean, those are all something that someone else could come in and take over for you.
Yeah, and I think if you showed someone, hey, we do all the catering for this local schools, right? And as long as you're continuing with the quality and everything that you've already accomplished, they're probably going to still use you. They're using you because of the relationships the restaurant has.
Yes.
And I think, again, if we're talking valuation, those things all come into future sales that you can predict.
Exactly. And I think the other part here is, if you are thinking of selling, right, putting a value to your time, but it may be worth offering, hey, I'm going to be there for 3 months because I do have a relationship with the school, and I'm going to kind of glad hand, make sure that, everyone agrees, everyone's happy before I leave. There's a value on both sides. And sometimes when we're coming up with a valuation, ultimately a selling price, you can even work in like a consulting. Hey, pay me, $5,000 a month for 3 months, and I'll be on call 40 hours, whatever it is. could be worth it on both sides because
Yeah.
that person is probably going to be willing to pay you
Right.
to help them, especially navigate some of these other relationships beyond
Yes.
the four walls. The other part of this is intellectual property. So I think this really comes a lot into play for, we talked about brand. I mean, there's also recipes, right? If you're a brewery, did you come up with your own products?
Right, exactly. Are those, is anything that you have, whether it's, like Angela said, like a brewery, a recipe for your food, is that valuable to somebody else? Or can they just make it themselves? If it's just a hamburger, it's a hamburger. But if you have these great sauces or these great ice cream or there's something that other people can't do, that would be valuable, right? Just like any sort of technology, same thing would translate to the intellectual property part.
Yeah, and that's the other part that, again, I go back to, not to knock Biz by Style, because it's probably the best website for this, but I just laugh when it says, like, pizza place, right? Like, I'm sure they have a great recipe, right? Like, at one point, they had a concept they were working on that was unique in some capacity. You are not going to get the value you deserve if you just put pizza place, right? We want to explain to them what makes it unique. Recipes have a value. Again, the biggest thing to think about, I think, as someone who's looking to sell is, as a buyer coming in, what you're really buying is time, right? If you had to start from scratch, say it is the pizza place, right? You had to start from scratch, you had to go through a build out that's probably a year and a half. You had to then come up with a brand, you had to come up with a name, you had to find employees. Then you have to go develop relationships with the local school. Then you have to come up with the secret sauce that you're going to bottle and sell, right? That's years of someone's time. So if I come in, there's a value to me buying this. Even if you say, I hate this place, I'm leaving, never want to be here again, right? There is a value to someone.
Right.
And you have to see that value, I think, from their side before you can think about some of the other things that you could position as part of this valuation. And then the final one is proprietary technology. I think, again, looking at some of the software you've set up might not necessarily be fully proprietary to you, but if you've helped to build out a software infrastructure, I mean, there's value there as well.
Yeah, any system that you're already using from, like I said, technology system on an inventory system that's already set up, or even a surveillance system, anything you have that's already
Your
done.
Ring camera has value.
Everything, like I said, is saving that person time.
Yeah.
So there is value to them because if it's working, they don't have to reinvent the wheel. It's already there for them. They can use it. So especially as you get into like recipe costing cards and stuff like that, that would be
even all of your recipe cards being done.
Right.
There's a value there.
Yes. So something like that, a labor system you're already using in place, all these things that if you could transfer over and you're going to give them labor templates that you've already created, you're going to give them all these systems, we talk about par ordering and prep systems. There is, if they're already really good systems, there is value in that because it works for your specific restaurant.
Yes. And the other thing I would say here is, again, I would not wait for a broker or, consultant who's sitting somewhere else to come up with this, right? You, the owner, know all of these intangible things. And even if there's a question if it has value or not, go ahead and put it, right? Because it's showing all of these things that someone's not even going to think that you could have. And there's a dollar value there.
Because unless you're sitting on the intersection where the land's all the value, you're going to need all these.
There's something, right? There is something there. All right, so our next one is, now if we went through the valuation, let's say, worst case scenario, we went through the valuation, we have a negative, right? We had a loss. We're just not there yet. We have a tax return that still has a loss. We're not going to be able to use that approach. And we went through our intangibles and it was what it was, but it's really not generating the value that we think is there. The next method, which especially is important for restaurants and anyone really who has a lot of equipment, is the idea of an asset-based approach. Now, I think here, and this is where, I laugh because so many times I think the brokers miss this, the consultants miss this, because what happens is, as a tax person, I can tell you that we depreciate your assets, right? You tell me you had a build out, and I'm like, bonus depreciation, right?
Exactly.
That thing is blown away in year one. Which means if I go and all I'm going to do is hand a broker my tax return, I have zero for fixed assets, right? I have a very little number, and I tried by design to keep it as low as possible. So on paper, my tax return shows very little for my assets. But if I walk around my kitchen, right, as we see even here, there is value to that equipment. And if anything, the weird thing of the last 3 years is with inflation, the used market, right, for equipment,
definitely.
some of your stuff may have actually appreciated in
Right.
value. So it's a very weird disconnect. So again, being your own advocate, right, whether it matters or not, my recommendation here is go and do an inventory of every piece of your equipment and Google it, right? It's probably one of your new hire staff's 5 hours of their time, right? Go take a picture of the oven, find out how much it costs online, and put together your own asset inventory.
Right.
Because just going by, your traditional valuation methods, they're really not going to work with tax depreciation.
Right.
And, what have you seen in terms of like equipment, right? I mean, the used equipment
Oh,
market
absolutely.
is crazy.
Because of not being able to get some new equipment, the used equipment shoots up. Kind of same thing in the car market, right?
Right.
And used cars have never been worth what they are now. It's because you can't get some of the new cars,
Right.
Or you can't. The new car price have shot up. So same thing. The ovens and all these other equipments, that air conditioning systems, some are just you can't get right now.
Yeah.
So it makes these used even more valuable, and like Ann said, could actually be worth more than
Right.
your original number, depending
Right.
on the price you got in at.
And even if your potential buyer doesn't value this or doesn't think this is important, I mean, it really is you kind of justifying the dollars you spent. Because on the flip side, if they're like, well, you didn't make any money the last years. Yeah, but I bought a new oven and I bought a new refrigerator. I upgraded my walk-in cooler. Like some of those things have real value to your operations as a whole, to your efficiencies. And we have to be the ones that bring that to their attention. So in this case, if we're looking at asset value, the first one, like we talked about, is, go to the next slide, is just looking at our book value approach. Now again, this is where we would look at not just the assets we have, but all of the things that we have on our balance sheet. So it's called book value, but it's really more of our balance sheet approach. Now, a lot of times the other part that we forget here is the value of our inventory.
Right. And exactly. And that's, depending on what your ending inventory is, and depending on what you carry, if you were heavy on wines or liquors, that's a huge number.
Yeah.
That you could get, state laws depending how you get, it all would be very valuable to the next person coming in. Same thing if you were high end, steaks, things like that, you probably don't have as much backstock.
Yeah.
But especially to get into like liquors and wines, it would not be uncommon to have a large volume discount, volume, assets on that.
Yeah. And that's where I think, again, so many times we rush to get a number, right? Just give me a number. What's my business worth, right? But this would really take some time because we'd want to take off full inventory. Think about paper products. During COVID, people were ordering like pallets of boxes because we couldn't get them.
Sure.
Or on the brewery side, people were ordering, pallets of aluminum. We couldn't make the cans fast enough, couldn't get the cans fast enough. So, there's probably some real dollars there that we need to take our time and inventory ourselves and then be able to show it, with technology, take pictures, just so they can see this really is part of what you're buying. On the other part of this would be really looking at liabilities. So again, here I wouldn't worry too much. There's really two things to look at here. The first one is, is the new owner going to have to assume any liabilities? Potentially if there were like sales tax stuff or, maybe there's, cash that they're going to keep in. But most times the liabilities you have are really things that are going to wind down with your sale. So what we want to think about here is what's the dollar amount that I need to get to make sure that I can wipe clean all my liabilities and continue on. And I think the big one here is that EIDL loan. Right? Like a lot of people took out an EIDL loan during COVID, which was fine, but chances are we need our selling price to be able to clear off our EIDL loan and then move forward. The other thing here, which again, we offer consultations all the time, would be to be able to, really work through any do to, do froms, intercompany stuff. So there's probably two conversations here. One is what's the value, what's staying with my new buyer, which is probably your inventory, your fixed assets, and then maybe if there's some lingering sales tax stuff, it's usually the biggest culprit. But then the other part is what's the part that you're going to take with you that's going to erode some of this, money that you get out of it, which is a whole separate conversation. So our next one that we're going to cover is really working through, so net asset method. Again, we would want to look at the market value. This is something, there are companies you can have pay to come in, kind of doing an independent evaluation of some of your assets, that may be worth it depending on if you did a build out. Again, the big thing, like we talked about before, what someone's buying is time and also not having to go through the hassle. And if we think about the cost of build outs today versus what they were 5 years ago, there's a value to a fully built out restaurant that is way more than it was 5 years ago, just because it would take you a year and a half. It probably cost you 30%, 40% more just to get the same built out space. So even if nothing else, there is a value to your four walls, and that's what we're trying to do with that method. Okay, so then, just thinking about our other valuation methods. Oh, can you skip? Yeah. Okay, so again, to review, our first approach was our multiplier, where we took our net income, we added back the owner benefit, and we used that 2.5 baseline. Second method was our asset base, really looking at what's in our four walls, what do we have in inventory, what do we have in fixed assets, what carries with the new owner, and showing a value that. And if we really find that neither of those work, right, or we don't like the result of either of those, the third method that we're going to talk about here is our discounted cash flow valuation. Now, this is going to seem a lot of math, but really the core of this is to say, okay, if I have a restaurant in Midtown Manhattan, right, obliterated by COVID, say my, entire restaurant was based on the lunch crowd of the office building, right? Not good. My third option in evaluation would be to prove out future earnings, right? If I was someone coming in today, it doesn't matter that it was horrible for the last 3 years, right? That's my problem, not you as the new owner. So you're coming in, and now I'm trying to prove to you that you're really going to make more than what I made in the last 3 years. And a lot of this, I think, comes down to thinking again about the sales side, right? Customers, maybe customer trends.
Yeah, definitely how 2023 is looking. Like you said earlier, really what's the first 7 months of the year looking like, because that is a good telltale how the rest of the year is going to man out, how it is versus last year, and showing growth in both the sales and profits from. So I think it's a great way to look forward, but using some of the immediate past that will probably help your numbers look a little bit stronger.
Yeah, and the other thing that you've seen a lot, I think, in some of your consulting is the idea that catering's just coming back.
Right, exactly. The bigger groups, depending on certain areas and certain sort of regulations when they came back, when people felt comfortable, I think we're seeing that now stronger than even maybe, last summer or the end of the prior year.
And that's, I think, something that you would want to showcase in any of these methods, but in this method especially, is that even if I look at a tax return for 2022, half of that year may not have had catering yet, or people weren't booking parties yet, or if they were still small, where it really took a year to get some of these bigger off-site caterings to come back.
Yeah, you're probably starting to finally go against those numbers, I would think, this summer.
Yep.
I think for most restaurants, last summer felt pretty normal on that side of it. But like you said, the first half of the year in 2022 really wasn't there yet in all, in all capacity. So.
Yeah. So we want to think about that, and even if you have to play around and say, okay, I know that by summer 2022 my numbers were there. Maybe my future cash flows are off of those 12 months, like July, or July to June or whatever it is, to get a 12-month window to say, okay, this is really the window to look at. This is how I'm going to do all my calculations. Yeah, I have a tax return for 12 months, but that's kind of irrelevant because it includes, 3 months where I didn't have a price increase, I didn't have some of these other things that you did as part of your rebound. So again, this one is by far the most flexible. I would say this is the most risky. I was talking to a gentleman this morning working through evaluation. He wants to buy a business and he has a couple on the table. And even though the one has higher revenue, it lost money, and it's really hard to trust that what you're seeing in a future cash flow is reality.
Yeah. Definitely from a seller standpoint, right? This may or may not pass the eye test.
Yeah.
From a buyer's, it might tell your story better than you want to tell it.
Yeah.
And that's great. As a buyer, you want it to be as strong for you as possible.
Yeah.
From a seller, on the other hand, they might not
it's
predict the future and allow your sale to go like that.
Right. But again, I think that's also, having those conversations. I mean, I think there is some intangible there. Like I said, even the gentleman, it's like he knows one has a better location. He kind of knows where it is. So it doesn't hurt to invite the buyer in, you know, have them come in, see the volume you're doing on a Friday night, see the energy, the vibe, because that also is going to tell your story more than looking at numbers that could be 12 months plus behind.
Yeah.
All right, so then now we go back to, okay, we looked at our numbers. Maybe we don't love it, right? Probably if you're in hospitality, you don't love what you see when you look at the last 3 years. But that's okay. I mean, I like to say if you're open today, you owe yourself a pat on the back, right? You made it through the hardest 3 years the hospitality industry has ever faced. But we're here to tell a story. So what we want to do is take all of this that we've learned from our business, right? Because now we've gone through our assets, we've gone through our inventory, we've gone through our net income from the last 3 years. Whether we like it or not, that is what it is. But we know that in those numbers, there are things that we really can control and drive our valuation higher. And this is something that you love to speak about, right? Is the idea that there's 5%.
Right, and that's the thing is we're trying to increase our valuation. We have to increase net income, and to do that is where the operations come in.
Yeah.
That's where if we can save 5% in labor, or 5% in food cost, or 5% somewhere on expenses, that's going to directly impact your bottom line, which is obviously going to directly impact that net multiplier that you were talking about earlier.
Yeah, and I like to say, you know, as much as we, you know, we want to think, okay, status quo is fine. I mean, from a valuation standpoint, you have to have 10% hitting your bottom line after you've paid yourself, right? Like inclusive of paying yourself and your car and all those other things you want to run through the business, you have to hit 10%, which means your operating income has to probably be 15% to then have room for those other things. But we can't let another month or a year go by where we're sacrificing for our business, because ultimately we are then hurting our future. I've had customers who've been in business 30 plus years, can't sell it for what it's worth because they always sacrifice. Right? They were always the one who said, I'll work for free. I'll take a $30,000 payroll for the year while my manager made 80 and everybody else got a bonus. Right? Like that's not serving you. No. It's not. And it actually is hurting the potential of your business. When we say you're leaving money on your table, you really are leaving, for every dollar you leave on the table, that's $2.5 in your valuation. Right? So we have to look at this as a priority to get the math right, and people do, right? You've come from large corporations that find a way to make it work.
Absolutely. They know what they want out of it, right? They start with the bottom line, what they need out of it, and then they work backwards on, well, what can we afford from expenses, labor, what target do we need to run on food costs, and that gets them to there. I'm kind of starting with that end in mind. This is where we want to end up, so we have to make sure the P&L looks like this to get there.
Yeah. And the key is, you know, if nothing else, hopefully this drives home the idea that this isn't optional. Right. Like, at the end of the day, there's going to come a point in time where you want to get money out of this business. Yeah. And if it doesn't show it on paper, it's going to be very hard to do, but there's no reason it can't show it. So I think, you know, as a next step, what we like is, you know, take a look at this, email us if you'd like a copy of these slides, and we offer 30-minute consultations with Scott and myself where we literally will walk through this with you, because I think the biggest eye-opener for me is, you know, my motivation has always been my dad had a failing business and it failed when I was in middle school, and I remember thinking it was only because he didn't know how to run a business, right? It wasn't a bad product, wasn't a bad anything, but it truly was, it missed on the math equation. And if nothing else, I think the last 2 years has taught us that we can't let that happen, right? There's too many great hospitality businesses out there that really deserve their time in the sun. And the only way to get there is making sure the math works. And if we do nothing else, we want to make sure that your equation works for you and your equation works for your future. So please contact us. We're here to help, and we hope that you've gotten a lot out of this episode, because this is such an important conversation for anyone in business to really understand sooner rather than later.